Hey everyone, welcome back to another episode of Real Estate Shorts. I'm Alex Morkate, and in this episode we're going to talk about mortgage payments. We're going to define what they are, how they're calculated in an interest-only and in a fully amortizing loan environment. We're going to explore the payment function in Excel as a tool to help us calculate it, and then we're going to wrap up by illustrating how these two different kinds of loans and their subsequent payments are going to impact the ending balance of a loan through time. Let's get started. Okay, so first, what is a mortgage payment? I think the easiest way to describe this is the amount that you owe to repay the loan that you've borrowed to your lender, whether it be a private lender, a bank, or really any other party, for having borrowed that amount. Now, I think in commercial real estate, you'll most often hear mortgage payments being referred to as debt service. And debt service is really just that way to describe you servicing the debt, you meeting the obligations of that debt or of that loan. And so in this example, I think we have a pretty straightforward case. You're going to borrow $1 million and you're going to have a 4% interest rate. In this case, the amortization term doesn't apply. We'll speak about why in a moment. But we have $40,000 worth of annual debt service. So I think what really tends to trip some folks up is how that payment is calculated under different loan types. So before we get there, then make sure that we all understand that debt service is recognized below the line being defined as net operating income. So debt service is always recognized, it's always accounted for, it's always calculated and organized below net operating income. And we'll talk about why in a moment. So first, let's explore the interest-only loan. So under the interest-only loan circumstance or type, the borrower is responsible for paying the amount due only to satisfy the interest amount owed to that lender. So with every payment that goes by, with every month, with every quarter, with every year that goes by, the borrower is really only paying enough to meet the interest required. So again, in this example, we have a $40,000 annual debt service. How did we get there? It's 4% annual interest rate times the $1 million borrowed. And so if we're looking for monthly debt service, for example, we would divide $40,000 divided by 12. But I think the key point here is that interest-only loans only pay interest. Now, this contrasts with an amortizing loan. So if you'll notice, it's the same amount borrowed. It's the same interest rate. The only difference is that now we have 30 years within which we need to pay down that $1 million borrowed. So again, if you'll notice, the annual debt service increased from $40,000 to $57,300 almost. That extra amount paid every interval goes to repay principal, to repay the loan amount borrowed. I also need to make sure that you understand, or it's clear, that this is not a linear relationship. It's not like saying, let me take the $1 million, divide by 30 years and divide by 12 months, and that'll give me the amount. It's actually a curvilinear relationship. And so I'll explore this in a lot more detail as we talk about amortization tables, because I think it's easiest to illustrate it in that example. So for now, without going down that rabbit hole too far, I simply wanted to illustrate that having an amortizing loan means that your payment is going to be a composition of two things: the interest due as well as the principal due. So as it's the interest due, and it also includes a portion due or a portion necessary to gradually pay down the amount that you've borrowed. So you'll find loan applications across the board, but it really tends to come up whenever we're talking about acquisitions and development. So we're going to calculate debt service whenever we're trying to figure out, do we want to buy this property or do we want to build this project, so that we can figure out whether we'll have enough equity or to figure out if the performance on the investment is going to be worth our while. The second is to try to determine the impact of leverage. So if we were to borrow, is it a good thing or not? Are we better off paying all cash given the relationship between the performance of the investment without borrowing and the performance of the investment with borrowing? So again, I'll explore the discussion of positive and negative leverage and how it's calculated in another video. But I think for now, just simply recognize that borrowing is going to really require you to define under what terms. And the first term you need to qualify is it interest only or is it fully amortizing? So if it is fully amortizing, I wanted to walk through the function in Excel. It's the equivalent function on a calculator, but the function in Excel for you to be able to calculate an amortizing payment. So let's come back to this example. $1 million borrowed at a 4% interest rate with a 30-year amortization, a 30-year term to repay the loan. I think implied here is the ending loan balance is going to be 0. So if you have 30 years to repay the loan, that means that the last payment in that last year will have reduced the principal amount owed to 0. So let's take a look at how this works. So first we have the payment function. So equals PMT open parentheses. And we'll really just walk through each one of the assumptions. So rate comes first. So we'll take rate and divide it by 12. It's an annual interest rate. So let's make monthly adjustments to it because your loan is going to be due every month. Under that same logic, we have term quoted as 30 years, but it's not really 30 years. It's really 360 monthly payments. So again, we'll multiply by 12. Next, we have present value. So how much did you borrow? What's that initial loan amount? The $1 million. And then finally a 0, the future value. So the ending loan balance at the end of the amortization term. So with this, we can calculate our monthly payment. And then we simply annualize it to turn it into annual debt service. So really keep in mind that every payment calculation, when we are speaking about an amortizing loan, it's part of a time value of money sequence or a time value of money methodology. So keep in mind that you have 5 total inputs. So rate, term, present value, future value, and ultimately payment. You have 5. You're going to be given 3 or 4. So in this case, we're given 3. And the 4th is implied because we understand that at the end of the 30th year, that ending loan balance will be 0. So again, just to recap, we have rate divided by 12, term times 12, present value, future value, close parentheses within the payment function. And then we multiply by 12 to get an annualized estimate for annual debt service. So finally, what I'd like to do is to illustrate what happens as we have this comparison between an interest-only loan and an amortizing loan to this loan balance through time. So I think it's probably easiest if we look at it at the extreme. What happens 30 years from now in an interest-only loan? I understand that I'm oversimplifying the interest-only loan kind of concept, but just roll with me that for the next 30 years, your interest rate won't change. So if this is true, you have $1 million borrowed today, and at the end of the 30 years, you're going to have $1 million left. You still owe the $1 million. You are only paying enough to pay the interest that was due, not to gradually pay down your loan. This is different than an amortizing loan, so that at the end of the 30th year, you're going to owe nothing. You will have been paying more during the interim. During those 30 years, you would have been paying more than the interest-only option. But on the other hand, now you don't owe anyone anything. So obviously, plenty of pros and cons here. Again, we'll explore them when we talk about positive and negative leverage. But for now, I really just wanted to illustrate that first, the payment calculation is relatively straightforward, time value of money concept. And 2, it really depends on whether your loan is interest only or if it's amortizing. So just to recap, we first kind of defined what that mortgage payment was. We spoke about the alias of mortgage payment, debt service. Then we spoke about how that payment is calculated under an interest-only and an amortizing scenario. We explored the payment function in Excel and then illustrated how the different loan types are going to impact what that future loan balance or value is going to be. So if you found this video helpful, here are a handful of others that I would recommend that are associated with this one. And as always, if you have any questions, comments, or feedback, I look forward to hearing from you. Talk to you soon.